Life is a journey filled with wonders and uncertainties. We make choices every day, each with its own set of potential outcomes. This inherent unpredictability is what we call risk, the possibility that something could happen for better or worse. Understanding risk is essential to navigating the complexities of our world. Risk is not inherently good or bad. It is simply a measure of the potential for change. Some risks offer the chance for great reward, while others threaten us with loss. Learning to identify, assess, and manage different types of risks is crucial for making informed decisions and achieving our goals. Think of the universe itself. It is a vast expanse of unknowns. Yet within it, stars are born, galaxies collide, and planets form. We embrace the uncertainty of space exploration because the potential for discovery outweighs the risks. Similarly, in our daily lives, we must learn to embrace uncertainty and make calculated decisions based on our understanding of risk. By acknowledging and managing risk, we empower ourselves to pursue opportunities and navigate the unknown with confidence. Not all risks are created equal. We can broadly categorize risks into two main types, speculative and pure. Understanding the difference between these categories is essential for developing effective risk management strategies. Speculative risk involves the possibility of both gain and loss. Imagine flipping a coin. You have an equal chance of winning or losing money. This is the essence of speculative risk. The outcome is uncertain, and you could come out ahead or experience a loss. Investing in the stock market is a classic example of speculative risk. The value of your investments can fluctuate, potentially leading to profits or losses. Other examples of speculative risks include starting a business, gambling, or entering a competition. Pure risk, on the other hand, presents only the potential for loss. There is no upside. Consider the risk of a house fire. If a fire occurs, you could experience significant financial loss. However, if no fire happens, you don't suddenly gain anything. Pure risks often involve events that are beyond our control, such as accidents, illnesses, or natural disasters. Other examples include theft, lawsuits, or unexpected death. While we cannot eliminate pure risk entirely, we can take steps to mitigate its potential impact. Insurance is a powerful tool for managing risk, but not all risks are insurable. Certain characteristics make a risk suitable for insurance coverage. Understanding these elements is key to navigating the world of insurance. First and foremost, an insurable risk must be accidental or unintentional. Insurance is designed to protect against unforeseen events, not deliberate acts or predictable outcomes. For example, you can't insure your car against damage you intentionally cause. The potential loss must be measurable and definable in financial terms. Insurance companies need to be able to quantify the value of what's being insured to determine appropriate premiums and coverage limits. A vague or subjective loss, such as emotional distress, is difficult to insure. The risk should be predictable in terms of its frequency and severity. Insurers rely on historical data and statistical models to assess the likelihood of a particular event occurring and the potential financial impact. This allows them to calculate premiums and manage their overall risk exposure. Additionally, insurable risks are typically non-catastrophic in nature. Insurance works best when dealing with individual or localized events. Large-scale catastrophes, such as widespread natural disasters or pandemics, can overwhelm insurance companies and make it difficult to provide coverage. Finally, the premiums charged for insurance must be economically feasible for both the insured and the insurer. The cost of coverage should be manageable for the policyholder, while also allowing the insurance company to generate a profit and maintain its financial stability. Insurance companies assess risk carefully when determining coverage eligibility and premium rates. They categorize individuals or entities into different risk classes based on various factors. Understanding these classifications can help you navigate the insurance landscape more effectively. Standard risk refers to individuals or entities that fall within the average risk profile for a particular insurance type. They typically have a history of responsible behavior, good health, and no significant risk factors. Standard risk individuals generally qualify for standard insurance rates and coverage options. Substandard risk applies to individuals or entities that pose a higher than average risk to the insurer. This could be due to pre-existing health conditions, a history of accidents, or engaging in risky activities. Substandard risk individuals may still be eligible for insurance coverage, but they will likely face higher premiums or limitations on their coverage. Preferred risk represents individuals or entities that present a lower than average risk to the insurer. These individuals typically exhibit excellent health, maintain a safe lifestyle, and have a strong track record of responsible behavior. Preferred risk individuals often qualify for lower premiums, enhanced coverage options, or other benefits. Insurance companies use sophisticated underwriting processes to evaluate risk and assign individuals or entities to the appropriate risk class. Factors considered during underwriting can include age, health history, driving record, credit score, occupation, and lifestyle choices. Section 5. The Art of Risk Management. Risk management is the process of identifying, assessing, and controlling potential threats to an organization or individual. It is an essential practice for safeguarding assets, minimizing losses, and ensuring the long-term sustainability of any endeavor. The first step in risk management is to identify potential risks. This involves systematically examining all aspects of an operation, project, or individual's life to identify potential sources of harm or loss. This can be achieved through brainstorming sessions, risk checklists, reviewing historical data, or consulting with experts. Once risks have been identified, they need to be assessed based on their likelihood and potential impact. This involves estimating the probability of a particular event occurring and the severity of the consequences if it does. Risk assessment helps prioritize which risks require the most attention and resources. After assessing the risks, organizations or individuals must select appropriate risk management methods. There are several strategies for handling risk, including risk avoidance, risk reduction, risk transfer, and risk retention. The most appropriate method will depend on the specific risk, the organization's risk tolerance, and the available resources. Implementing the chosen risk management methods is crucial for mitigating potential losses. This may involve establishing safety protocols, implementing security measures, purchasing insurance coverage, or diversifying investments. Finally, it is essential to regularly review and evaluate the effectiveness of risk management measures. This involves monitoring for changes in the risk environment, assessing the performance of existing controls, and making adjustments as needed. Section 6. Sharing the burden. Risk sharing techniques. Risk sharing involves distributing the potential impact of a loss among multiple parties. This can be an effective way to manage risks that are too large or complex for a single entity to bear alone. Risk sharing allows individuals and organizations to pool their resources and share the burden of potential losses. Co-insurance is a common form of risk sharing in the insurance industry. With co-insurance, the insured and the insurer agree to share the cost of covered losses in a predetermined ratio. For example, in an 80-20 co-insurance arrangement, the insurer would cover 80% of the eligible costs, while the insured would be responsible for the remaining 20%. Reciprocal insurance is another risk-sharing mechanism where a group of individuals or organizations with similar risk profiles come together to form an insurer. Each member of the reciprocal contributes to a common fund which is used to pay for losses incurred by any member of the group. Reciprocal insurance allows members to benefit from shared risk and potentially lower premiums than they might obtain from traditional insurance companies. Joint ventures and partnerships also involve risk sharing. When two or more parties engage in a joint venture, they agree to share the profits and losses of the undertaking. This allows each party to leverage their resources and expertise while spreading the risk of the venture across multiple entities. Risk sharing can be an effective way to manage large-scale projects, investments, or other endeavors with significant financial exposure. By pooling resources and distributing the potential for loss, individuals and organizations can mitigate the impact of unforeseen events and pursue ambitious goals with greater confidence. Section 7. Shifting the odds. Risk transfer. Risk transfer involves shifting the financial burden of a potential loss from one party to another. This is often achieved through insurance contracts where the insured pays a premium to the insurer in exchange for financial protection against specified risks. When you purchase insurance, you are essentially transferring the financial risk of a covered event to the insurance company. The insurer in turn pools the premiums collected from many policyholders to create a fund that can be used to pay for claims. This pooling of risk allows insurance companies to manage large and unpredictable losses. Risk transfer can also be achieved through contractual agreements. For example, a construction company might include a hold harmless clause in its contract with a subcontractor. This clause would stipulate that the subcontractor is responsible for any losses or damages arising from their work, effectively transferring the risk from the construction company to the subcontractor. Another example of contractual risk transfer is the use of surety bonds. A surety bond guarantees that a party involved in a contract will fulfill its obligations. If the party fails to meet its contractual duties, the surety bond company will step in to cover the resulting losses. Surety bonds are often required in construction projects, financial transactions, and other situations where one party's failure to perform could result in significant financial harm to the other party. Risk transfer is a valuable tool for managing risks that could have a significant financial impact. By transferring the financial responsibility for certain events to another party, individuals and organizations can protect themselves from potentially devastating losses and focus on their core operations. Section 8. Minimizing the impact. Risk reduction and avoidance. While risk transfer and sharing can help manage potential losses, it's often more effective to reduce or eliminate risks altogether. Risk reduction and avoidance are proactive strategies that aim to minimize the likelihood or severity of potential threats. Risk reduction involves taking steps to lower the probability or impact of a risk event. This might include implementing safety measures, installing security systems, conducting regular maintenance, or providing employee training. For example, a manufacturing company might invest in automated safety features on its production line to reduce the risk of workplace accidents. A homeowner could install smoke detectors, fire extinguishers, and a security system to reduce the risk of fire, theft, or other hazards. Risk avoidance, as the name suggests, involves completely eliminating exposure to a particular risk. This might mean choosing not to engage in a risky activity, avoiding certain locations, or refraining from investing in volatile assets. For instance, someone who is afraid of heights might choose to avoid skydiving or bungee jumping. A business operating in a politically unstable region might decide to relocate its operations to a more stable country. The choice between risk reduction and avoidance depends on several factors, including the nature of the risk, the potential consequences, the cost of mitigation, and the individual's or organization's risk tolerance. In some cases, it might be possible and practical to eliminate the risk entirely. In other situations, it might be more feasible to reduce the likelihood or severity of the risk through mitigation measures. Section 9. Conclusion. Navigating the risk landscape. Risk is an inescapable part of life. From the moment we wake up to the time we go to bed, we are constantly making decisions that involve some level of risk. Understanding the nature of risk, the different types of risk, and the various methods for managing risk is essential for navigating the complexities of the modern world. Speculative risks, with their potential for both gains and losses, offer opportunities for reward, but also require careful consideration and a tolerance for uncertainty. Pure risks, on the other hand, present the potential for loss only, and we often seek to mitigate these risks through insurance, risk sharing, or other strategies. By understanding the elements of insurable risk, individuals and organizations can make informed decisions about which risks to transfer to insurance companies and which risks to manage through other means. Risk management is an ongoing process that requires constant vigilance, adaptability, and a willingness to assess and adjust strategies as needed. Ultimately, our ability to understand, assess, and manage risk determines our capacity to embrace opportunities, overcome challenges, and achieve our goals. By developing a sound understanding of risk and implementing effective risk management practices, we empower ourselves to navigate the uncertainties of life with confidence and resilience.